So the government is opened back up for business. Now, what is the risk for stocks? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, please go to the website at www.prudentmoney.com. Send your question in and I will get that answered for you. That's a great way for us to get information and resources to you to help you with whatever you might be dealing with, whether it's risk, whether it's investments you're using, whether it's planning, do a lot of planning. And happy to help if we can do so. Never a cost for these emails. All at prudentmoney.com. Well, so the government is opened back up for business. All the votes got in, everything taken care of, the bill signed. But really, what progress did they make? Well, they do what they kick the can down the road. They get to a point where they can't come up with a good, viable solution, so they put it off to another day. In fact, this particular situation that we're trying to vote into a permanent law is, well, not law, a permanent situation. I think it's for at least for the next year or so. Just gets kicked down the can and has been kicked down the can several times before. So we're trying to get to a point where something will be favorable for both sides. And the one big sticking point is health care coverage, costs, the subsidies, and how all that's going to be taken care of. So I believe that they have the government opened until the end of January. Now, this is what makes things very, very interesting, is that you've got the midterms coming up at the end of 2026, and there's a very good chance that the Democrats could take back control. I'm not sure. I think of both houses, both Congress and the House. And that would, of course, dramatically change the dynamic of things. So how President Trump approaches this is going to be very interesting to watch, how strategic he is. He typically, when he first negotiates, and you saw this with the tariffs, where he would go for the throat at first, be outrageous in his demands, then he backs off, and then he comes in with a more reasonable middle ground. And we'll just have to see. I think he's going to have to handle this a little bit differently. But, we're not out of the woods yet. And the Democrats, I think, may have more to lose than to win by giving in so quickly. And, of course, President Trump's never going to look like he's giving in. Compromising, but never giving in. Because it's, after all, not his fault. And that's what they always do, the politicians. It's the other party's fault. So if I had and this is a good place to start, a workshop coming up, and we're actually talking about doing one in January. But if I had a workshop coming up, and what I used to do in the past was to make a list of everything we got to keep our eye on. And I remember doing this in 2020, right before COVID just really got intensely bad. And I was doing a workshop, and I put the list of things, and there's typically there's a long list of risks, most of which don't amount to anything that you think they're going to, and kind of fix themselves. But then you've got the big risks that as I was going down and listing all these things, preparing for that Saturday workshop, I thought to myself, well, I better put down COVID because that's starting to be, talked about, and something that I guess really, I don't know what it would look like, but could become a big risk. And of course, none of us knew what it would look like, and it became a bigger risk than any of us thought. And so I just happened to jot that down on the master list. So if I were to put together a master list for this next year, it would be, I think, quite interesting because it would be a number of types of situations would be brand new to the list. The first one, and I think that the most important one that could literally make us fall off the very tightrope that we're walking on as an economy is the valuation of artificial intelligence stocks and the bubble that we call AI stocks, the AI stock bubble. And when I say valuations, and this is really important for you to understand, I'm really talking about stock that is Wall Street says it's way more valuable than it actually is. So let's say once again that a AI stock is worth $100 a share. And if you look in the future, and this is where they get these numbers, they look in the futures and they say, well, in the future, you're supposed to hit this number and this number and this number. And it could be realistic or it could be fantasy land. And then you start to look at the stock price. And so the stock price says, well, that means that we should be at 200 and not 100. And so you get to $200 a share. And now you're worth what Wall Street says you're worth. Then Wall Street says, no, you're actually worth more than that. And so the number goes up again. And so somewhere in that number, whether it's 150, 125, 200, whatever a share, lies the real number. Now, companies will announce these numbers during earnings season. It's like presenting your report card to your parents. You're supposed to make this grade in this particular subject, this grade in this particular subject. And so it's a report card for each company to determine how they did. And if they met expectations, which are very, very lofty expectations, which are perfectly candid or not real, they're kind of fantasies. It's like monopoly money. Or it is what you say it is, the right person saying it. Then when that becomes a reality that, hey, that's not the real value, then the stock starts to sell. Well, everybody knows that most of these AI stocks are way, way, way overvalued. So said another way, if the stars line up and all these things come to pass and no problems, no risk, everything is perfectly, which is never going to happen that way, then the stock is worth, $400 a share. Was worth $100 a share. Now it's worth $400 a share. And people are just buying it, while very, very softly, very silently, the people who work for the company and the people who are kind of inside Wall Street are selling the stock because they know that there's no way the stock's going to stay at these levels given what's in front of it. So these valuations, and of course this spreads out into the entire stock market, and we have what we had in 1999-2000. We had the bursting of a tech bubble, and there's something else that's very interesting that's happening that I have not seen really happen since the tech bubble. And I'll go over that here in just a minute. So I would start out my list with the valuations of AI stocks. Because here's some of the problems we talked about yesterday. Infrastructure being a big one. They don't have the infrastructure. They still have to build it. Just think of the example of electric cars and that the government wanted everybody to drive an electric car. Well, we don't have the infrastructure for it. And it would take years upon years upon years to get that in place. The effects on the electric grid, really nobody's talking about that, but this is these huge data centers, they require electricity. And so you're looking at a big demand on the electricity markets. The willingness to act quickly, and I really do think this is a bigger issue than most people are giving validity to, And that is, there's certain companies that AI is a slam dunk for, and they'll be implementing, and they already are implementing some of that, and they're laying off people because of it. Now, shift forward, once you get that small percentage of companies in place and get their AI systems up and running, then you got everybody else who's a little bit hesitant, I think, to move quickly into the AI space, to stop doing what they've always done and replace human capital. And that's the big one. Am I going to lay off half my workforce? Now, just think about it. If you're a CEO and you're being asked to lay off a big percentage of your workforce and you're going to replace it with AI, do you think that you would feel just overly confident about it? So, knowing that is the future, I think that we're talking baby steps instead of big jumps. But the market is valuing these stocks on the big jumps. And so that's what you've got to consider. Then the second one I would put is the economy and inflation, or stagflation. And the economic reports that were not released in October, it was announced yesterday, and I will attempt to stay off my soapbox on this. The inflation numbers and the employment numbers that were supposed to be produced in October, released in October, will not ever be released. Now, ladies and gentlemen, this is one of the most ridiculous things, top 5 at least, ridiculous things I think that has come out of the Trump administration. Why in the world would you withhold information and not be transparent about something that we look at all the time? Granted, it's past its old news, but it is data that's important because it goes to answer the one question we all need to be following, and that is this a trend or was it just a bad one-off month? And it's absolutely, there's no good reason for them to withhold that information, and it looks like they're going to. In fact, if you want to take a couple steps back, if you read the history of the Department of Labor, they've had these shutdowns before in the past. In fact, there was one in 2018 to 2019, and it was before this one. It was I think the longest at 34 days, and the unemployment numbers by the Department of Labor were still released. Now, they still know how to get the information together. They still know how to work it, and yet President Trump does not want those to be. He had a guy. He put his own guy in there to run the particular function that produces the labor statistics for that month, and they shut that down, and they're not even supposedly figuring out stocks, but figuring out these numbers, but they could still figure them out and release them late. So, maybe, I don't know, it's pure speculation, but I don't like the lack of transparency. And I think that's a slippery slope we're walking down. So the economy and inflation, as far as inflation goes, well, let me back up. As far as the economy goes, I think we're still holding on barely, but I think we're still holding on. I would be just surprised if we start to see negative numbers. Maybe down the road we're going to see that. I do think that the employment sector is just now starting to see these problems start to bubble up to the surface. So we'll talk about that on the other side of the break. This is Bob Brooks. Stick around. I'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know that I do appreciate it. Listen, a couple things. If you have not gone and listened to the podcast, we do podcast every one of these programs, and you can check it out at your convenience wherever you like to listen to your podcast. We're on every major platform. And make sure you go to the website and sign up for the email newsletter list. This keeps you posted as to when we do post things, and that's a good way to stay in touch with Prudent Money. So that's all at the website, www.prudentmoney.com. And if you'd like, you can always go to the Ask Prudent Money site, and which is at the top. The link is at the top of the page. Click through and send us a question. We'll get you taken care of. That's all at the website, prudentmoney.com. We're talking about the economy. Like I said, I think that we're going to start to see issues with the economy, but I would imagine it's still pretty much holding on. Inflation should not, unless they're tinkering with those numbers again, should not look good. I mean, if you've been to the grocery store, if you've started contemplating what you're going to have for Thanksgiving and started pricing out some things, it is not cheap. And I think that we all know that. So what you have is you've got a bout of inflation that's all of a sudden kicked up. And, of course, this whole thing with tariffs has not been resolved with the Supreme Court on whether or not he had the lawful right as president to sign an executive order and take care of these and take the actions without the approval of Congress. That will be interesting to see what they come up with on that. But we've definitely have we're looking at inflation and problems with prices going up, and I think that's what we will see in those reports. Well, once we start to see a trend going down on both, then you start. If you're the Federal Reserve Board who has to raise rates or lower rates, you have to go. Which one am I going to do? Because right now we've got stagflation, which is when you have inflation, you have a recession, all at the same time. So I'd have that down on that list. And let's see here. And here's another thing that's interesting that I'm starting to see as far as the stock market. And I haven't seen this since 1999. And that is, and follow me on this, it's the rotation of stocks from growth stocks to value stocks. And this happened in a very big way, and it happened in 1999. You started to see people sell growth stocks, which was running everything, and you started to see them buying value stocks. And I really haven't. I watch things pretty close. I haven't seen as big of a rotation out of growth stocks into value stocks as I'm seeing the last couple of days. Why I tell you that and why it's important is because even though we went through a situation where NASDAQ lost, 60, 70% of its value. The S&P lost 45 to 50%. Because of the technology and the bust in technology stocks. You did have a situation where value stocks did very well and made money during a bear market. And there was a lot of value-based mutual funds that did very, very well. And so I just say that if you're trying to figure out how to balance out your portfolio, this is not intended to be given as advice, but just keep in mind, value stocks can separate from the pack and perform on their own and do pretty well, which makes for a very, very, very good hedge to protect your portfolio. So it's something that you might want to keep in mind. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. I wanted to go over some Q&A, and I like to do this on Thursdays to kind of wrap up the program and talk about revisit some things that we talked about during the week. One of the reasons I went for several reasons why I went through everything yesterday. And if you didn't get a chance to listen to yesterday's show, I really go into very deep detail as to why I think we're going to have a tech bust 2.0 that looked a lot like 1999 to 2000, or actually 1999 to 2022. And if you haven't had a chance to listen to it, I definitely would take the time. I think it gives you information and puts it all in one place to where you can start to see what I'm seeing. And I think it's good information to know when you're trying to invest your 401k accounts and other accounts that you might have earmarked for retirement. So always important to be invested as where things are happening. It's an interesting situation. I'd love to see it. If we're going through any kind of a bust, I would love to see that happen again, obviously. But there was the reason we were talking about it, I circle back around, the reason that we were talking about this at length yesterday was because I wanted to point out that Wall Street is expecting and investors are expecting AI just to take off and be put into companies at a quick pace, which I don't believe is going to happen just because of the problems that we stated yesterday. And so having said that, I don't think that this issue of being laid off because of a robot's about to take your job is anything that's going to be a mass scale for a pretty long time. I could be wrong, but so I wouldn't go and be extremely worried about that. And I would still do the 2 days ago we did a program on what to do if you do get laid off, and you can go back and listen to that as well. I think we should always be prepared. Having said that, I don't think that we should expect bad things to happen, but just to be prepared. I mean, I think that's a principle of prudent stewardship. So we also talked about gold the other day, and the question came up: how would you use it in a portfolio? Well, keep in mind we got a mania going about gold because everybody thinks it's going to be the next currency, or there's a very strong group of investors that think it's going to be the next currency. I don't, and for many, many reasons. I think you just play it as an investment, and it could be and I don't like physical gold as much as I like ETFs and mutual funds, but I would look at something like 10% of your portfolio to where that you could put into gold, and just have it for the diversification. I think the diversification is smart. Right now, it's going through an amazing uptrend, and how far it will go, who knows? But right now, there's the belief that the instability of our country, that gold is a place to be. I would say I wouldn't invest in gold because of that reason. I would invest because I was wanting to diversify my portfolio, and I wouldn't take the advice of a lot of people who are marketing gold that you need to put all of your money in gold. I think that's not a good idea, and just be careful of make sure that you run it by somebody and get another opinion on any of these things that these marketing outfits are asking you to do. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you do have a question for me, please go to the website, www.prudentmoney.com, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.